Imagine discovering a place where growth is happening faster than almost anywhere else on the planet. A region where economies are expanding, middle classes are rising, and opportunities for investors are multiplying by the day. This is the world of emerging markets, a financial frontier where fortunes can be made, but only by those willing to understand the risks, the trends, and the unique dynamics at play. For decades, investors focused on developed markets like the United States, Europe, and Japan, seeking stability and predictable returns. But in the last few years, smart investors have shifted attention toward emerging markets, spotting explosive growth, untapped potential, and opportunities that the rest of the world is only beginning to notice. Emerging markets are countries that are transitioning from developing to more advanced economic status. They often have rapidly growing populations, expanding urbanization, and increasing industrialization. These factors create a fertile environment for investment, as demand for infrastructure, technology, consumer goods, and financial services skyrockets. Countries like India, Brazil, Indonesia, and Vietnam are at the forefront of this trend, with GDP growth rates that consistently outpace developed economies. For investors, these high growth rates translate into opportunities to capture returns that are simply unavailable in slower growing, saturated markets. One of the main attractions of emerging markets is their expanding consumer base. As millions of people rise into the middle class, demand for goods and services, everything from smartphones and cars to healthcare and financial products soars. Companies that can meet this demand stand to gain enormous profits. Investors who understand which sectors are benefiting from demographic shifts can position themselves to ride these trends. For example, the rise of digital payments and e-commerce in India has created immense opportunities for investors who identified early adopters in these industries. Consumer-driven growth in emerging markets is often faster and more pronounced than in developed economies, making it a key driver of investment strategies. Infrastructure development is another major catalyst. Emerging markets often face gaps in roads, energy, telecommunications, and public services. Governments, often supported by foreign investment, are pouring money into these areas, creating opportunities for private companies to participate in projects ranging from energy grids to transportation networks. Investors who spot these trends early can benefit from both the construction phase and the long-term economic growth that follows. Infrastructure investment doesn't just produce returns directly. It also stimulates broader economic activity, creating a ripple effect across multiple industries and sectors. Natural resources also play a pivotal role in emerging markets. Countries rich in minerals, oil, gas, or agricultural products can leverage global demand to fuel economic growth. For investors, these resources present opportunities not only through commodities, but also through related industries such as extraction, processing, and distribution. For example, rising demand for lithium and cobalt to power electric vehicles has put certain emerging market countries at the center of global supply chains. Investors who identify resource trends early can position themselves in companies and sectors that are poised to benefit from long-term global shifts. Technology adoption is accelerating in emerging markets faster than in many developed countries. In regions with limited legacy infrastructure, businesses and consumers leapfrog outdated systems, adopting mobile banking, digital services, and renewable energy solutions at unprecedented speed. This creates fertile ground for investors in fintech, telecommunications, and tech-driven services. For example, mobile payment systems in Africa have created opportunities for both local startups and international investors seeking exposure to rapid digital adoption. In emerging markets, technological innovation can happen faster because there's less resistance to change and a massive untapped user base ready to embrace it. Political and economic reforms in emerging markets are also creating opportunities. Governments in countries like Vietnam, Indonesia, and Mexico have implemented reforms to improve ease of doing business, reduce corruption, and attract foreign investment. These changes increase investor confidence and reduce barriers for companies seeking to expand. Smart investors pay close attention to policy trends, understanding which regions are reforming effectively and which may face political headwinds. Knowing the landscape allows investors to position themselves strategically, balancing risk and potential return. Emerging markets can also offer diversification benefits. By allocating capital to economies that are not perfectly correlated with developed markets, investors can reduce overall portfolio risk while capturing higher growth. For example, when stock markets in the U.S. or Europe stagnate, emerging markets may continue to expand, providing opportunities for growth that balance slower performance elsewhere. Diversification in this context isn't just about geography. It's about exposure to different growth drivers, demographics, and economic cycles. Emerging markets allow investors to hedge against stagnation in mature economies while tapping into dynamic growth regions. Exchange rate movements are another factor investors consider. Currencies in emerging markets can be volatile, creating both risk and opportunity. For example, a weakening local currency can reduce returns for foreign investors, but it can also make investments cheaper initially. Conversely, currency appreciation can amplify gains. Savvy investors often hedge currency risks or use them strategically to enhance returns. Understanding currency dynamics is critical when investing in emerging markets, as they can influence overall profitability and timing of entry and exit. Sector-specific trends often drive emerging market opportunities. Healthcare, for instance, is a rapidly growing sector in countries with rising populations and increasing access to medical services. Education and online learning are expanding as demand for skills increases. Consumer goods, energy, infrastructure, and technology sectors all offer pockets of explosive growth. Smart investors analyze demographics, urbanization trends, and industry-specific dynamics to pinpoint which sectors are likely to outperform. Timing entry into high-growth sectors can result in returns far beyond those available in developed markets. Investors are also capitalizing on urbanization trends. Cities in emerging markets are expanding rapidly, creating demand for real estate, transportation, and urban infrastructure. This urban growth fuels construction, retail, and service industries. By understanding the pace and nature of urbanization, investors can identify opportunities in property development, logistics, and consumer services. Urban centers often become hubs of economic activity, concentrating wealth and demand, which can be highly lucrative for early investors. Challenges in emerging markets cannot be ignored. Political instability, regulatory uncertainty, and infrastructure gaps create risk. Currency volatility, inflation, and governance issues can affect returns. Yet, these challenges are often balanced by the potential for outsized growth. Smart investors approach emerging markets with rigorous research, risk management strategies, and diversified exposure. The ability to navigate volatility is part of what separates successful emerging market investors from those who struggle. Risk is inherent, but when managed properly, it is also a source of opportunity. Technological leapfrogging is another trend, boosting emerging market returns. Countries that bypass traditional infrastructure limitations adopt advanced solutions directly, such as renewable energy grids, digital finance, and mobile-first technologies. This rapid adoption accelerates economic development and creates investment opportunities in cutting-edge sectors. Companies that facilitate or benefit from these leapfrogging trends often see outsized returns, particularly when early investors identify them before widespread adoption. Demographics also play a crucial role. Emerging markets typically have younger populations than developed countries, driving consumption, labor, supply, and innovation. Young, urban populations adopt technology quickly, demand new products, and fuel economic expansion. This demographic dividend provides long-term growth potential that can sustain high returns for investors willing to commit capital with a multi-year perspective. Understanding population trends allows investors to anticipate future demand and align investments accordingly. Global trade patterns influence emerging market investments as well. Countries that integrate into global supply chains, export goods, and attract multinational operations often experience accelerated growth. Investors look for nations that benefit from globalization, free trade agreements, and foreign investment inflows. Being part of the global economic network positions emerging markets for rapid industrialization and revenue growth. creating profitable opportunities in both domestic companies and multinational partnerships. The path to success in emerging markets requires patience, research, and flexibility. Volatility is higher, news can move markets quickly, and unexpected geopolitical events can influence returns. Yet, the potential upside is enormous. Investors who understand sector trends, demographic dynamics, technological adoption, and government policies can identify opportunities that generate returns far beyond what mature markets offer. Smart investors treat emerging markets not as a gamble, but as a calculated strategy for long-term growth and portfolio diversification. For viewers, the lesson is clear. Developed markets are no longer the only place to grow wealth. Emerging markets offer dynamic growth, innovation, and opportunities that can't be replicated elsewhere. Success requires awareness, strategic entry, and the ability to weather volatility. Investors who position themselves correctly can benefit from rising consumer demand, urbanization, technology adoption, and economic reforms, capturing gains as these markets mature. Emerging markets are more than a trend, they're a global shift in opportunity. So, when thinking about where smart investors are putting their money today, emerging markets are impossible to ignore. They represent the next wave of global economic expansion, fueled by demographics, technology, urbanization, and reform. For anyone seeking growth, the key is to study trends, understand risks, and act strategically. Emerging markets aren't just a place to invest. They're a window into the future of the global economy, where opportunities are as vast as the challenges are real.